It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast, independent real estate news for Australian property buyers, investors and homeowners. Without that sales agenda, that's pretty important because we are not a real estate company, so we're not trying to sell you anything. It is completely independent. It is a Thursday, March the 12th. If you're looking at trying to secure yourself a rental in Adelaide at the moment, some news out of Adelaide where it's just become a little bit more expensive. PropTrack reported a couple of days ago about new data showing unit rents in metropolitan Adelaide have jumped around 10% over the past year. That is pushing the median to around $550 a week. It's another sign, isn't it, of just how tight the rental market remains across Australia. While the extreme price surges we saw in 2022 and 23 have started to cool, there is this other phenomenon, and that is the demand for apartments and higher density housing. In this sector, it is still incredibly strong and tight, especially not only in Adelaide, but also Perth and Brisbane at the moment. Well, let's go to Melbourne right now and catch up with Yannick Ieko, the CEO from Harmony Group. And a very good morning to you, Yannick. Welcome to the Real Estate Breakfast. Half Belgium, you were telling me, and half French, and you've been here about 20 years.
Good morning, and thank you for having me on your show. That is very much the case.
First thing to talk about is property selection, because identifying assets with high rental demand and capital growth potential, if you go back 10 years ago, you really had to look to find out where those top performing areas were. Today, you can virtually go anywhere in Australia. It's all up.
It is all up. There is up and up. So I would still very much say that your due diligence and your homework is going to take you to places that are outperforming others, but you would be hard pressed to get a negative return from your investment.
I guess that you will see this. Somebody in Melbourne only investing in Melbourne because they like the rental market there. They know and understand the rental market. But because everything is mushroomed, people are in Brisbane, people are in Perth with their rentals, and they will still chase it.
They will. And look, you're mentioning Victoria specifically. Certainly one thing we've seen, and I think this is not about to stop anytime soon, is that Victorians are being forced to invest out of Victoria because of the land tax and the changes that have taken place here in regards to that. It's got a tremendous impact on cash flow for investors, and they are way more likely to entertain interstates than anyone else in Australia. But yes, from a portfolio building perspective, diversification, risk management, it's certainly very appealing to build a portfolio across the whole country at the moment.
We're all following what is happening overseas at the moment with the Israel, US and Iran war. The RBA meeting is not that far away. Everybody is going to be very curious as to what the RBA might do. Probably in many ways it might be just a little early, but there might be enough signs for the RBA to go into maybe increasing the cash rate. How do you see that?
The outcome is inevitable. The question mark remains around the timing of it. I certainly, when I speak to clients, when I speak to investors, when we work numbers, we absolutely factor in interest rate increases over the course of this year. And what's happening currently internationally and in the last few hours, to be honest, is certainly speaking to in that direction. So we are expecting it to happen. As you said, March might be a bit early, but throughout the course of this year, it seems inevitable now.
Yeah, if you're in the UAE, we were talking last week to Mario, our guy on the ground, and there's this vibe at the moment where people are just sitting on the fence. They've not signed off on properties that they were about to. We're a long way away from the action, but you're dealing with investors. What sort of concerns at the moment have investors raised with you in terms of pushing forward?
Look, it hasn't transpired too strongly quite yet. I think we are very far, and so far there's that feeling that it won't affect us in the general public. It will, and some people are starting to talk about it. As I said, from our perspective, the most direct impact that it will have on investors is cash flow related with increased rate, but also borrowing related with rates going up. Investors' borrowing capacities are reduced, and that we know has a substantial impact on the market almost instantly. So we are watching very closely, but the general public and the investors in general here, certainly in real estate, haven't factored the developments in the Middle East in their decision making quite yet.
One of the sectors that you're quite deep in is rentvesting and helping investors get into rentvesting. Hasn't this, in terms of talking of mushrooms, boy, this is blowing up, hasn't it?
It certainly has, which I think is circumstantial. I suspect it's more by necessity than choice, despite the fact that in many circumstances it is the best choice and it should have been entertained regardless of the necessity. But yes, we are speaking to many, many more younger people who are finding that this is essentially the only way for them to go. And I'd like to reassure them when I speak to them, and I would do the same with your listeners. Not only is potentially the only choice, but it is almost every single time from a financial perspective, the best choice.
We are talking to Yannick this morning, and he is in Melbourne. When we come back, we're going to talk about multi-generational property investing. It is a big one. It is growing. That is up next.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs, and hidden gems.
Well, since we mentioned the Middle East, one of the problems for the thousands of Aussies living in Dubai at the moment is the latest talk around desalination plants. Some think that Iran is going to target them to create even more chaos in the Middle East. Now, these desalination plants, if you didn't know, they are the survival mechanisms to supporting life in the UAE. And just for context, here is one commentator talking about just how much of a problem this is and what the Iranian new leadership might have in mind.
My sense is that we're going to see more escalation from the Iranians. I mean, the regime is hardened. It's united. The security services are united. The Revolutionary Guard Corps is definitely in charge. They have a very aggressive and, forward-leaning leader now in Mujtaba Khamenei. I think that the thing that worries me most is if they go for what I would call the nuclear option, which is not a nuclear bomb, but rather they try to attack the desalination plants in the Persian Gulf and on the Red Sea. If they knock out the water desalination plants, it would mean that, large cities with 7-8 million people like Riyadh, we're already seeing this problem in Bahrain, by the way, because a desal plant there was attacked. Large cities don't have enough water from the aquifers to sustain themselves. And you would have a real kind of crisis in the kingdom, in the UAE. Dubai wouldn't survive without desalination. And you would have a major problem for these countries. So if we start seeing desalination plants being attacked, then really all bets are off. And it's an all-out war. And I suspect that it would require ground troops to bring down the regime in Iran.
Yeah, so that is a serious problem when it comes to desalination plants. Let's get back to some more real estate news because new data shows that the Gold Coast is now overtaken both Sydney and Melbourne to become the most expensive place in the country to rent a house. The median weekly rent in the Gold Coast is sitting around $950. That is well above Sydney at $810 and far higher than Melbourne. So that is a reminder that lifestyle cities are now competing with the traditional big capitals when it comes to housing costs, especially as population growth continues to push demand and push it pretty strongly.
Don't forget to subscribe. We have so many episodes, all designed to help you better understand the constantly evolving and dynamically changing real estate property market.
It is a Real Estate Thursday right around Australia talking property, lots of it. There's all sorts of things at the moment to just keep in the back of our minds. I do want to move on to multi-generational property investing. Yannick is with us from Melbourne. We're talking about those rentvestors and just how much that has grown, this is another area, no doubt, you are heavily in the weeds on, multi-generational property investing.
Yes, that is something that has absolutely boomed at micro level, and what we're experiencing from clients where we are being contacted by families that are investigating their options together. And it creates a number of challenges, especially around sort of people being in different phases of their life and requiring different outcome from the one investment. But at the same time, the pooling of resources is also very powerful. So you've got pros and cons, but we are certainly experiencing a much heightened demand for those particular conversations over the last 12 months.
How difficult is it when you've got everybody in the room and everybody's got a different point of view? You know, this can be across 3 generations, right? You've got the grandma, grandpa, you've got the parents of the children, so it's kind of 3 ways. And sometimes that is sort of a recipe for chaos.
It sure can be. Look, you have different philosophies, different life experiences, and as I said, different outcomes that people are seeking. Typically, the older generations, whether it's the parents or the grandparents, are very focused on cash flow, and they need the investment to deliver some money in the bank months in, months out so that they can live from it. On the flip side, you have the younger generation, which is probably working professionals. They're less concerned about the cash flow, but they're very interested in the potential for future capital growth. And we have to reconcile those demands. You have to reconcile those investment philosophies where the older generations might be more traditional and anchored in what they've seen working over the last 50 years, which is not necessarily optimized for the current situation. So it creates some very interesting conversations. But, you know, families are used to that, and eventually we tend to come out with an outcome.
Just in terms of time frame, because when you're talking about different philosophies spanning 50, 60 years across 3 generations, how long typically, if you're in that scenario with those 3 generations, would it take from the time somebody's talking to you to the time you actually sign the deal?
Isn't that an interesting question? Look, I would say typically a month to a month and a half would align everybody in sort of the same direction and allow them to move forward. It can take longer, particularly with that 3rd generation. If the grandparents are involved, sometimes it's a bit slower. But between parents and kids, I would say 1 to 2 months tends to iron out everything.
All right, we'll leave it there on our Thursday morning from Melbourne. Yannick, thanks for coming on to the Real Estate Breakfast. Really appreciate it, and enjoy the rest of the week.
Thank you so much for having me, and until next time, same to you.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
But the land tax payable there, it's been more of a change in the threshold. So it's brought a lot more properties that perhaps in the past weren't subject to land tax. So certainly in the apartment market, that threshold has dropped from, I think, 300,000 down to 50,000. So that brings a hell of a lot of apartments that previously weren't subject to land tax into that threshold.
And how have you found the market so far in 2026 in your neck of the woods?
It's been a bit inconsistent, Craig. Certainly we noticed through November and December last year, the market had been building through spring, but when it came to sort of November, December, when the talk of inflation starting to grow and become a little bit sticky, and the RBA started talking a lot more about potential interest rate rises than further reductions, then there seemed to be a bit of hesitation. And certainly the first home buyers in the sub $950,000 mark have been reasonably active, and that's driven a lot by the federal government first home buyer scheme, so that's helped that sector of the market.
We connect you to the best real estate information across Australia. The Real Estate Podcast.